Hello, my name is Matt Fields, and today I'd like to talk to you about payroll taxation and deductions. The subtitle of my talk is Explaining to Your Teenager Why Their First Paycheck Was So Disappointing, because that's the point in time when this conversation really becomes most relevant. So my professional background, I'm a CPA, I have my MBA as well, and then my Juris Doctorate. The EIEIO was an honorary degree that I got from Old McDonald. Our payroll tax system, getting back to our talk here, the payroll tax system is a source of many taxes and deductions as government entities, state, local, and federal, use this point to get a hold of the tax revenue, which was formerly your money, before you spend it foolishly on trivial things like food, shelter, and clothing. This presentation will outline some of the ways in which this process happens and where the money from your paycheck actually goes. The first concept we need to understand is net versus gross income. Gross income is what you were promised by the recruiter or the employer when you first signed up for the job, that you would make, for instance, $10 an hour. Net income, or take-home pay, is the disappointing reality that the 40 hours you worked last week did not translate to $400, but rather $310, the amount remaining after the government entities or private parties had taken their share. Whether you feel that that amount was fair or not, that's not their problem. So the basic paycheck math goes like this. What I was promised is gross income minus the deductions made on behalf of other interested parties equals your net income, or what my take-home pay actually is. You can't just blame your employer for the fact that your paycheck was so disappointing. They have to comply with the laws of where they are located, and by law, federal, state, and local income taxes have to be withheld from your pay. In addition, the payroll system is the source of funding for two important government programs, Social Security and Medicare, that will benefit you down the line when you retire. Well, that is if there's still money in those systems, but that's a different talk for a different time. Let's talk about those two systems, Social Security and Medicare, first. Social Security tax, which is currently 6.2% of your pay, is also called the FICA tax. FICA stands for Federal Insurance Contributions Act, which cleverly avoids the word tax in the title. That's good political work, really, taking people's money without calling it a tax. Social Security is a government program that pays senior citizens a monthly income when they've stopped working, and certain other people, disabled people, and dependents. And whenever any politicians threaten to reduce Social Security benefits, they are promptly voted out of office or not elected in the first place, usually accompanied by political ads that show grandma being thrown off a cliff for dramatic effect. These programs may bankrate the federal government eventually, but that apparently is somebody else's problem. Moving on. Medicare tax, currently 1.45% of your wages, provide medical benefits once you reach 65. The Medicare system is critical for senior citizens who incur massive medical costs and would otherwise be uninsurable. So I'm going to withhold my political commentary on that for now, and let's press on. So the Social Security and Medicare tax means that 7.65% of the amount you earn immediately goes to the federal government, and those amounts are not refunded to you no matter how little money you make. Once you've paid that 7.65%, though, you are not done paying taxes. The next type of deduction is the income tax deductions of the federal, state, and local governments. Rather than try to chase you down for money that you owe them after you have most likely spent it on yourself, the government requires your employers to deduct it from your pay and send it to them immediately. Federal, state, and local income taxes are reported on various tax forms to the government in the first part of the year after the income was paid to you. Here we have an example of form, the Federal 1040 form, on which you report to the federal government all the income you made from all the sources of income you had, your job, your businesses, your rental properties, money that you made from selling stocks or stuff, etc. All of it on this form so the government can assess their share of it. It's called a voluntary system, but it's voluntary similar to the way payments to the mob are voluntary. If you don't pay, they will come after you and cause you lots and lots of pain. While the U.S. government doesn't break legs or leave you encased in concrete at the bottom of the Hudson River, they will still get their money from taking whatever money you have left, wherever they can find it. Once you finish paying the various government entities, the state, local, and federal governments, a variety of other organizations have a monetary interest in your paycheck. It is really common to pay for health insurance, contribute to your retirement savings accounts, pay union dues or charitable contributions directly from your pay. Some of these are less voluntary than others, but at the end of the day, more money is being taken from your account to pay for things or that may or may not benefit you. If there's anything left after all these deductions, you actually get to keep it. So with the remainder of talk, I want to focus on some of the other forms that we use, and you will encounter when you go to work and are going through orientation for your job. They are federal forms like the W-4, I-9, W-2, and 1040-EZ, and state forms like the IT-1040, which is used to report state taxes in Ohio. Since Franklin University is in Ohio, and so am I, it's my first point of reference on all of this stuff. The W-4 form helps your employer determine how much to pay your income tax bill at the end of the year. Believe it or not, you actually have some control over this process. The amount an employer withholds for you is based on a formula, and the driver of that formula is number of dependents. Dependents are people that you support, like children or elderly parents or yourself, that you get a tax deduction for. So the more dependents, called allowances, that you claim, the less taxes you pay. You don't actually have to claim the actual number of dependents that you have on the tax return. That's the key point. The form is not for the government to use. So let's take a closer look at how this works for your advantage and how it could work for your advantage on the next slide. So line 5 is where you write your withholding allowances, which is another word for dependents. Here's where you have some control. If you put in a high number, your employer will withhold less money from your paychecks, which means you have more money each pay period, but your chance of getting a big tax return at the end of the year goes down. If you put in a low number, your employer will withhold a lot more money from your paycheck, and that money could come back to you in the form of a big tax refund. But since that was money that you earned all year long, really that tax refund is the return of money you loaned the government. And by the way, you made no interest on that loan. So maybe this could be helpful for you and something that you could use from this class in your life and in your first job. One more form you have to fill out is the I-9 form, which is a form that says you're eligible to work and you are who you say you are. In theory, you are not eligible to work until you've filled out this form and provided your new employer with identification that backs up the claim that you are who you say you are. But somehow millions of undocumented workers have found a workaround to the system. So apparently there may be still a few holes left in it. But this is what that form looks like. If you had a microscope, you would see that this form asks you for a couple of different forms of identification for all of your pertinent information, like your social security number, address, date of birth, etc., all to verify who you are. Another form that we use is the W-2 form. At the end of the year, your employer sends you a W-2, which tells you how much money you made for the year and how much taxes were withheld for federal, state, and local taxes, as well as other pieces of information, like how much your employer paid for their portion of the health insurance premiums if you bought your insurance at work. This is the form you take to H&R Block to have someone who took a weekend class in tax preparation ask you questions off a screen and charge you $200 to submit your taxes, all for something you could have done online for free if you weren't terrified of the IRS. Last but not least, here's the form that most U.S. taxpayers that are not homeowners fill out, the 1040-EZ form. It is a simpler form for taxes, and by simple I mean that at least 5% of the U.S. population could fill it out accurately and completely on their own. Usually, individuals only see this form when the professionals that they pay hands it to them at the end of their tax preparation, or the online tax remittance software prints it out for them. So, that is my talk on deductions and payroll taxes. You may have learned a few things and hopefully are well equipped to deal with your crestfallen teenager when their take-home pay was so much less than what they expected. Just put a hand on their shoulder, give them a little hug, and tell them that it will never get better and that it will actually get much, much, much worse. Welcome to being an adult.